Investing is important for building wealth and securing your financial future. It helps you stay ahead of inflation, which can erode the value of your money over time. Inflation makes your money worth less over time, reducing your purchasing power. Investing helps your money grow faster than inflation, allowing you to accumulate wealth. Investing can help you reach your financial goals, whether they are short-term or long-term. These goals might be buying a house, funding education, or retiring early to enjoy life. Investing can give you financial security and stability, ensuring a comfortable lifestyle. It can provide peace of mind for the future, knowing you are prepared for any financial challenges. Investing is putting money to work for you. It's about making your money grow over time by placing it in various financial instruments. You're buying something that you hope will increase in value. This could be stocks, which represent ownership in a company, bonds, which are essentially loans to governments or corporations, or real estate, which involves purchasing property. It could also be starting your own business, where you invest time and money to create something new and valuable. When you invest, you're taking on some risk. The value of your investments can go up and down, but you're also hoping for a reward. The potential for higher returns is what makes investing attractive. The goal is for your money to grow more than it would in a savings account, where interest rates are typically lower. Investing is a long-term game, not a get-rich-quick scheme. Patience and strategy are key to seeing your investments flourish over time. Before you invest, define your financial goals. What do you want to achieve with your money? Do you want to buy a house? Retire early? Knowing your goals helps you make a plan. It helps you choose the right investments. Your goals will also determine how long you invest your money. Section 4. Spreading your investments. Don't put all your money in one place. This is called diversification. Diversification means spreading your money across different types of investments. This helps reduce your risk. If one investment does poorly, the others can cushion the blow. Diversification is key to a healthy investment portfolio. Section 5. Don't put all your eggs in one basket. This old saying perfectly illustrates the concept of diversification. Imagine putting all your eggs in one basket. It might seem convenient, but it's risky. If you drop the basket, you lose everything. All your eggs are gone in an instant. The same principle applies to investing. Diversification is key to managing risk. Putting all your money in one stock is risky. The stock market can be unpredictable. If that company fails, you lose your entire investment. It's a big gamble. Diversifying across different asset classes, like stocks, bonds, and real estate, protects you from major losses. It spreads the risk. Section 6. Time is your friend. Investing is a long-term game. The longer you invest, the more time your money has to grow. This is thanks to the power of compounding. Compounding means earning interest on your interest. Over time, even small amounts can grow significantly. Patience and consistency are key to successful investing. Section 7. Understanding risk. All investments carry some level of risk. Risk is the possibility of losing some or all of your investment. Understanding risk is crucial before you invest. Higher potential returns usually come with higher risk. Lower risk investments typically offer lower returns. You need to find a balance that aligns with your goals and